2022 has been off to a tough start for both the stock market and the bond market. The reason for the rough starts are widely known. It's inflation, rate hikes by the Fed to tame that inflation, and the conflict, of course, in Ukraine. Craig Bolanos, the CEO and founder of Wealth Management Group, is here with the three things you need to know. Craig, what can you tell us?
Well, Angela, as you said, everybody knows about the worries, but I think it's important for our audience to know a couple things that they might not be aware of. Number one on my list, a bad start to the year. It's never fun, but it's not necessarily a sign of things to come. While 2022 certainly ranks in the top 10 worst starts to a year ever, what we can glean when we look back at the previous 10 worst starts is that stocks tend to bounce back nicely the rest of the year, up some 10% on average. I mean, the only times that didn't happen in history coincided with the Cuban Missile Crisis and World War II. Number two, Fed rate hikes don't necessarily lead to a recession or a bear market. The Fed recently announced a 50 basis point hike on May 4th, but looking at previous times of aggressive Fed tightening, we see that the economy and corresponding returns through the market cycle generally still provided positive annual returns. And that just makes sense because the Fed's raising rates to cool off an economy prior to it becoming too hot. So what does that mean? Well, if the economy wasn't healthy, if balance sheets didn't look secure, well, the Fed wouldn't be raising rates. Hence, it's likely that Fed rate hikes aren't going to cause an immediate recession.
Craig, it's always good to know history because sometimes history does repeat itself. What else do you have to tell investors?
Well, one more item, Angela, this would be number 3 on the list today, is that the S&P 500 peaked back on January 2nd of this year. And thus far, the low during this correction has been down some 14%. And it turns out, and maybe it's not just coincidence, there's been 24 other corrections since World War II, with an average decline of some 14.3%. And in those 24 other corrections, it took some 133 days to find the ultimate low. And given we're already through the first 4 months of the year, that's 120 days. History just might suggest, and it's the only guide that we have, that we're getting into a range where previous corrections have indeed found bottoms. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you'd like to learn more, you can check out our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.